But we're going to talk about Social Security today, because all of us have a Social Security record. In fact, you work here, it means that you're contributing. Your employer's contributing. Everywhere else you work, there was contributions. But this is one piece of retirement. It's not the only piece. It's a big piece. For a third of us, this is the only piece of retirement. Social Security for a third of Americans. The only piece. For 2/3 of us, it's the biggest piece. It's a big piece. I mean, if you're getting $1,000, $2,000, or $3,000 almost a month, that's equivalent to having almost $1 million in a retirement plan. That's a big retirement asset, just so you know. I work with people from all walks of life, and I can tell you that the wealthiest clients I have still consider Social Security their most important paycheck. And you would think, no, it doesn't matter to most people. Yeah, it does. And if you question it, I had a client about 4 years ago, unbelievably wealthy client, saved for 70 years, retired from giant tobacco company that put $1 million into each employee's accounts over the time period they worked there. Unbelievable time period, unbelievable company. This person was a saver. You know, the numbers were very, very high. When his Social Security check dropped $30, he noticed it. Called me immediately and said, "What's going on with Social Security? They're taking my Social Security away." You could tell this was the most important check for this guy. Now, his other monies, if it swung $100,000, he probably wouldn't have noticed, but he knew when $30 was missing from his Social Security check. So don't think that you're alone. And I'm in that boat too. You know, I want to make sure my Social Security check is there. So we're going to cover what Social Security is, how it's calculated, when you can take it, some of the gotchas. I'll let you know there's a couple of pieces in front of you. They're not very helpful. So at a few points, I'm going to ask you to write down something. And on the back of that booklet, flip it over to the very last page. There's a notes page on the inside, and you can use the back page and scribble anywhere you want. It's yours. But I'm going to say you may want to write this down because the info isn't in the materials. Okay? There's a lot that's not in these materials. As a matter of fact, you can see this. This booklet says 2019. A while ago, they just stopped putting the year on it. They use the same booklet every year. I'm not even sure why they put the year on it, because they took out the yearly changing information that you would care about. And it's very general, so that's why we're going to be very specific today. But in any case, I want you to actually take this book and go over to page 4. Yep, page 3 and page 4. There's a chart that starts at the bottom. Page 3 goes on to page 4. And find the year you were born. It's going to become really important because everything about Social Security hinges on that year and what your benefit is for the year that it says your FRA, full retirement age. We love our acronyms. FRA, you're going to see that a lot in Social Security materials. That's the year that determines what all your benefits are. If they're early, they pivot around what the balance is on your FRA age. If they're later, then they pivot on what the balance is on your FRA age. I can take that one number when you tell me, "Hey, Mark, my Social Security is $1,800 when I hit 66 in 2 months," and I can know what all your other benefits are. My spreadsheet can calculate it automatically. And we do that because in financial planning, we're trying to aggregate all your potential sources of retirement income: Social Security, 401k, IRAs, savings, rental homes, trusts, inheritances, whatever else you may have. And we're trying to figure out, after taxes, what you'll be able to live on. That's what we're trying to figure out. And you might not know how to do that, but I've been doing it a long time. It's really easy. I have 2 ways to get there to make sure that I know when I say to that person, "You're going to be fine," that you're going to be fine. But know that we start with the FRA age. For most of us, it's going to be age 66 or 67, somewhere in that range. 67 for me. If you're a little older than me, 66 in 2 months, 66 4 months, something like that. And all that is the amount. That's the time where Social Security's full benefit. It's not the highest benefit. It's not the lowest. It's something in between, but it's considered your full benefit. What does that mean? Well, we used to think of retiring at 65. Social Security kicks in at 65, a long time ago, not in the last 10 years. And about 12 years ago, maybe longer now, I'm losing years, track of time, but we changed the rules so that if you were over the age of 55, your full retirement age crept up, and now it creeps all the way up to 67. And warning for younger folks, younger I would say 40 or under, I think quite a few of you in the room, I would expect Social Security's full retirement age to increase again. It's not law. There's been a lot of consensus, both sides of the aisle. I go to these events that have lobbyists paid to come tell what each senator is thinking about Social Security, and they say this one, this one, this one. They, both sides, I can tell you, agree on raising that age to 69. 4 or 5 years ago, there was a giant event in Washington, D.C., jets flying in from Fortune 500 companies, CEOs interviewed by Senate, and they wanted to make it 70. They were promoting the idea of raising it to age 70. Tell your kids, that's my point. Warn your kids, save for retirement, because Social Security is kind of the goalpost, keep pushing back, and you're not going to have the time or the early years. I mean, just imagine being like a road worker at age 70, or an outdoor AT&T employee digging ditches at age 70. That'd be a tough thing to do. Probably easier in here, but not if you're physical. If you're a nurse or something, a little harder. So just be aware that age may creep up. But as it is, it's 66 or 67 for most of us. And that's just the amount that we base our benefits on. Here's what Social Security does. Well, let me ask you a question. I'm going to trick you a little bit. How many years of work does Social Security take into account when they figure out what your benefit is? They count the last 10? 5? Nobody's been to my event before. What did you say?
All of them.
I'm not going to answer that yet.
30.
How many?
30.
Darn close. 35. Yeah. So they count 35 years. And they don't just count the last 35 years, they count the highest 35 years. And before you assume, well, yeah, but when I was 20 I made like $4 an hour, realize they take the $4 an hour and the inflation adjust it up, so there's like $8 an hour now, or $9 an hour. And they try and equalize all years using the CPF formula, and then they weight 35 years. They take your highest 35 years. So just know this, that's important, because if you haven't worked 35 years, then in your case, you get a disproportional benefit to working an extra year. Every year you work, you're dropping, well, because they count 35 years, if you don't have 35 years, they're sticking zeros in for the years you didn't work into this 35-year average. So just think about that. It's kind of like, go back to high school. When you were a junior, you had 2.5, 3 years of grade points. And, if you got an F, it pulls the grade point average down. A couple nods in the room. And if you got an A, it pulls the grade point average up. Well, it's great if you could drop off an F. What if you could drop off an F, which you couldn't do in high school. But what if you could drop off an F and replace it with an A? Wouldn't that have been a great thing? Well, that's what Social Security does. You drop off a 0 and replace it with 30,000, 40,000, whatever your work is. So when I'm meeting with people, I regularly ask, how many years have you worked? If they don't have their printout from Social Security, how many years have you worked? Well, I worked 30, okay. And we were thinking of retiring, but every year you work, you're getting a bump up, above average bump up, because of that switching out of zeros for good years. And probably higher years, because as you're older, you tend to be paid more. Not always, but you tend to be paid more. So there's a benefit to filling in 35 years. Beyond that, every one of us has a different Social Security. They're going to average 35 years of work, and nobody has the same wages for 35 years. So what is your benefit? Well, I can tell you about what it is based on what you're earning, if you answered a few questions. And I can tell you the lowest benefits are, there is no lowest. And the highest benefit this year will be like $2,840. I write these down because they change every year. Here it is. So this year, if you're the lucky one, your highest benefit is $2,861 a month. $2,861 a month. Most benefits that I see are somewhere in the $1,100 to $2,200 range. I see a lot of $1,500 to $1,800 Social Securities.
Is there some place we can go
absolutely.
now, look at this?
Yeah. So all of us, probably from work, don't want to get you fired, but you can go to ssa.gov, ssa.gov, not .com. Someone told me that the other one's a bad place, so don't go there. .gov, and if you just scroll down about halfway down the page, there's a tile that says My Retirement. Look for My. That's the personal part. When you see My Retirement, click on that, and you can log in. You can actually create an account if you've never logged in. Real easy. Don't be afraid to give them your Social Security number. They know it. They ask you your social, your date of birth. They want to verify you with some credit and DMV records. Has anybody done an e-signature lately on anything? A home, an investment account? Yeah. They're using the same portable, that information. So it asks you like your old car model, your 1960s Ford, whatever. And if you can remember 3 of them, then you get verified. You can skip that part, by the way. It just it tries to add extra security if you want to go through that. Otherwise, it just sends you a little code like we're getting a lot nowadays. If you have a cell phone, you give it your email, we're going to send you a verification code. Boom, and then it verifies you. You can be in instantly, and you can see your record. It'll tell you what your projected benefit levels are at 62, 66, whatever your full benefit age is, and 70, just so you know. And you can see your full work history. So that thing we used to get a printout of, bifold every year, we don't get it anymore. Has anybody gotten one this year? Okay. We get it as we approach potentially drawing Social Security. Maybe, if you're close. 3 years, 2 years. I haven't exactly figured it out. It's like a lot of things that's changing. I used to get these materials down at the Social Security office. We print them now because they don't print them anymore. And so we printed them out for you today. Hang on to them because you won't get any more unless we do this again. All right. So we've covered how they figure it up, 35 years. Why you want to look at that work history. Maybe you left work to start a business, and maybe you didn't report income well. Maybe your employer went bankrupt and they stopped reporting income. You'd want to fill in years you can show that you worked that weren't in there. But most employers are reporting this stuff every month. And there's severe penalties when they don't. So as an employer one day, back in the past, I can tell you I woke up at midnight when I missed that deadline to get on the computer to enter that information because the penalties are outrageous. And so your information's probably in there. They average out these 35 years. You find out what your benefit is. And now it's kind of like dialing in income for retirement. I'm always taking multiple sources and dialing in what our income is every month. And this one lets you draw it at full benefit age, but you can draw it early. Now the earliest you can draw the retirement benefits is age 62. I want you guys to grab this flyer because there's a lot of meaningful information on here. You look at this little bar chart, that's really all we need here. And go to the middle of it, you'll see the line for $1,000, age 66. All right, so know that nobody's full benefit is $1,000 at age 66. I mean, it's just a random number they picked here to illustrate how it changes. So if your benefit were an even $1,000, you can see that if you drew early as you could, age 62, all the way over on the left, that would reduce that benefit about 25, well, exactly 25% in this case. So by drawing it early, 62 the earliest for retirement, we're reducing our benefit permanently 25%. Will it ever go up? Yes, but it's not going to go up like this chart. It's going to go up by a thing called COLA, cost of living. You guys see that in a lot of federal benefits, COLA adjustment, inflation-based. Last year they raised it 2.8%. So what we're seeing is if we elect to draw early, we retire early, we're giving up about 25% of the money. And that's permanently going to stay that low, only adjusting by COLA. But every time we wait, we're getting more. So you may want to write this down. This isn't anywhere in these materials. If we draw early, every month we wait, we get a monthly increase. And it works out to be, it's exactly 0.5%, so about 0.5%. Each month we wait, from the time 62 on up to full benefit age. So just write, early increases 0.5%, okay, per month. That's not exactly right, because if you're the youngest in this room, yours might increase at a slightly different rate for the first year and then go to 5/9. So it's 5/12 and then it's 5/9. It's kind of complicated. It's like everything is complicated, but just figure about 0.5% a month increase is about right. And it's monthly increasing. So we can dial in, okay, My spreadsheet might say your costs, your needs are $2,500 a month, and you hit that where you're able to exceed those with your income sources as we see your assets grow and we see your Social Security grow, and I can figure out what month you can retire. I can actually dial that in. And knowing the calculation is how we dial in the one part, the Social Security part. So 5/9 of 1%, and it's a monthly increase. But this all changes. So once we hit FRA, full benefit age, 66, 67, whatever it is, now it's not monthly. Now it's annually. This is really important because I've had guys that were accountants, ladies that were accountants, say, yep, I'm waiting till 66 and 8 months. My full benefit was 66 and 2 months, and I'm waiting to max out, and they're counting on a monthly increase. And they didn't get one. So they really didn't get paid, and they didn't get the increase. It was kind of a waste. They should have just gone ahead and drawn it. They'd given up money. That would be a mistake in financial planning. So annual increases, if you're going to wait longer than full benefit, just make it an annual decision and make it. Don't kind of second guess it and do it halfway through the year. So it goes up annually. Just remember that gotcha, okay? Annual increases after full benefit age. All right, so I've kind of given away that you can draw as early as 62, and then it keeps going up and keeps going up. What you can't see is there's a slight increase in this curve here. So it's going up about 5% a year for the early years, but when you do get past full benefit age, now it's going up 8% a year. I mean, think about that. It's guaranteed to go up 8% a year. Is your 401k guaranteed to go up 8% this year? It didn't last year. It is this year so far, but it didn't last year. It lost 7 or something like that. So that's a guarantee of increase that you can count on. It would almost make sense then to maybe draw from your retirement resources. If you were doing something like draw from one place and let Social Security rise, it would make more sense to draw from the thing that's uncertain, because this one's certain. And if you're going to delay drawing. I mean, I'm just suggesting ideas here. When I meet and do personal planning, I get very concrete. Here's what you should do. And then there's a payoff and a cost to everything you don't do. So it goes up annually, and it goes up 8%. And then once you hit 70, it doesn't go up anymore. It just goes up by cost of livings. No reason to wait past 70. Matter of fact, they're going to send it to you at 70. And they're just going to send you a notice saying, we're enrolling you and starting you. So there's no reason to go beyond that. And most people aren't going to go that long anyway. Most people are going to start at 62 or 63 or 64. Now, a common question I get is, Mark, when should I draw it? When does it make the most sense? When do I get the most money? Should I draw it early? Should I wait? When you turn on the TV, there's some very popular advisors that always say, tell me if I'm wrong, wait till 70, wait till 70, wait till 70. What if he died at 70? Would that be a good decision?
No.
My mother died at 67. If she waited till 70, gosh, terrible decision. It's kind of the reason why I'll probably draw it early, because I'm likely to die at a young age. I'm 50. I'm counting my last 17 years, maybe. My dad's still alive. He's almost 90. So I don't know. I'm torn on that one. But you get the idea. What's one thing none of us knows? We don't know when we're going to die. In my meetings, I regularly ask you, are mom and dad alive? How old are they? How's their health? What was the cause for the health problem? Did they smoke? Did they have a lot of bad habits? Are you similar? Are you different? We're trying to figure out if you're going to beat the average or not. Of course, we don't know, but you at least use the information you have. Genetics, family history, all that stuff. You take that into account. If you're going to live till 100, because every family member lives to 100, it probably makes sense to wait for you, but I'm not going to say that for certain. Okay? I have a client right now. She's been on Social Security for 5 years, called me at age 62 and said, Mark, I'm thinking of drawing Social Security. Now, let me just give you a little background. And this isn't the norm. Most of us would love to be in this situation. But Mark, I'm thinking of drawing Social Security. Her husband had died the year before. I think he owned Kernersville. I'm not joking. I think he owned Kernersville. He had this massive trust, left her set up for life. This was both widowers, and they married. And so he set up a trust that basically supplies her income till she dies. And prior to that, she had saved up for her retirement. Single mom, raising kids, somehow saved money. You know, you'd say that's impossible. She did. She saved money. So she had put away enough for a retirement with Social Security. And then when he passed, we did some planning around, you know, making sure the kids inherit something, making sure long-term care doesn't eat up your assets, you know, adding risk protections, blanket policies and stuff like this. In any case, she calls me this day and says, Mark, I'm thinking of drawing Social Security. Now, if she had called Susie Orman would have said, wait till age 70, because financially that's the smartest decision. I'm not disparaging Susie Orman. That's a right decision. Okay, in that case, that's the right decision. But then I asked her, well, what are you thinking of doing with the money? Well, we've taken care of my kids. We've taken care of, you know, making sure that the money doesn't disappear. And if I had that money, I would buy a new car. I'd probably replace it every 3 years. You know, if you've done everything, that's a good decision, isn't it? I mean, am I wrong here? Is the point to die with the largest number on your balance sheet? Right. So in her scenario, that made sense. Even though others said that's the wrong decision. You know, I disagree. It's a personal decision. You decide what's right for you. And, you know, I, as your planner, should only be thinking about what is important to you. And I, of course, want to weigh off, you know, well, I also know it's important to you to stay retired. So if you make this decision, it may cost you that. You know, I should point that out. But I shouldn't just dismiss every decision because financially or the spreadsheet says, you know, it should be. So that's my point, is don't think there's a right and a wrong decision. But to answer the question about if you die, people ask me, well, when do I get the most money? I would say this. You may want to write this down. This is really not anywhere. I wish it was. If you drew it at 62, that's the reduced. It takes somewhere between 12 and 17 years before that's a bad decision. Before you get a little less money out of the Social Security system. So you're 74, or even as late as age 79, before that could be a little less money. Think about that. You have to know you're going to live to 79 before you're certain that that's a bad decision. And if you know that everybody in your family dies young, that's an obvious decision in my book. You're actually going to assure yourself of getting less money out of the system if you waited. Does that make sense? So one consideration is, yes, how do I get the most out of it? The miser in me says, always get the most out of something. But the other side says, what are you going to do with the money? And then the third side says, well, it takes 17 years in some cases. So, you know, is it worth the risk? Is another concern. So we might get a little less money out of the system at age 79, but not that much. We have to live a lot longer before that starts to really magnify its effect. So you got to make it up into your 80s, you know, and into your 90s. If you're going to live to your 90s and you're certain of it, then that's probably a bad decision. And it's costing you something. You know, I could calculate it up based on your age and likely. So you can see it's not an immediately bad decision. And in many cases, you know, you might draw early because of that fact. But I want to warn you, the one reason you don't draw early is if you can't live on the money, right? You're not going to retire if you cannot make it. You're going to keep working if you can't make it. If there's one gift that I give in my meetings, it is to know with certainty that you can make it. Because most of us start and we're unsure and we're just like frozen in fear for years and years and years until we get by. And then I have these folks in their 70s, they call Summit, you know, something's missing from my accounts, I'm not able to make ends meet. Nothing's missing from their accounts, they're spending more money. After 10 or 15 years, our costs gradually crept up. And over time, what used to be a little surplus became a deficit, and we start to watch our savings drop. That happens. So part of my planning is to calculate in inflation. Because when you're 75, you don't want to find out suddenly the ends don't meet. You want to make sure that up front, you've kind of built in the next 15, 20 years of inflation into your planning. So you got to have an extra surplus now that gradually gets smaller, or maybe your assets get bigger and make up for it. You weigh all those decisions. Okay? Complicated, but kind of interesting. So we've seen we can draw it as early as 62, increases monthly. Then when we hit full benefit, in this case 66, then it starts to increase annually at a faster rate. 8%. And then it stops at age 70, no reason to wait. If we draw it at 62, we're taking the risk that 12 to 17 years later, if we're still alive, we've got a little less money out of the system. If you can live with yourself, you might choose to do that. If you're a spreadsheeter, you may not. We all decide that personally. I want to give you a couple warnings, a couple gotchas about drawing early. Probably do want to write these down. So this year, if you started drawing early this year, there's an annual income that you cannot work and earn beyond, or you'll find that you'll reduce your Social Security benefit. So for this year, if you decided to draw early, this is only for early Social Security retirees, you wouldn't want to continue to work and earn more than $17,640. $17,640. That works out to be $1,470 a month. Let's say you're working here and you're working part-time. Do they allow that? I don't know. But if you said, yep, I want 20 hours, 30 hours, whatever keeps you under this, it'd be smart. Your manager would love you if you said, I don't want to exceed $17,640, and tell them that at the beginning of the year. That's $1,470 a month. That's this many hours based on my wage rate. If you overtime me now, you're not going to get me in December, basically. And they don't want to lose you in December, so they'll just kind of keep you level, hopefully. I mean, that's what you want. You want to give them information. Because here's what happens. When you draw early, I don't know why this is, but it's in the books. It's been this way forever. They limit your income until you get to full benefit age, and then you can work all you want. Does that make any sense? Early ones can't work. Later ones can. Doesn't make any sense, but that's just, I think it was designed to keep people out of the workforce originally, but right now we have a short workforce, there's not enough people, so it's the opposite, and you would think that they would just kind of waive this law, but it's been there forever. So until we get to full benefit age, we have to limit ourselves to this. Now what happens if we exceed this? Once we earn more than this, we then start to give up $1 of Social Security for every $2 we earn. Yeah. So you lose $1 for every $2 you go over. And if it's the first year for Social Security and you're near that full benefit age, it's a little different. It's $1 for every $3. But just keep the $1 for every $2. That's the worst one. It's the one you should kind of think about. And this regularly happens to folks that usually I start getting calls around August. Again, it's called a summit, because we're a credit union and we have their banking and their credit, their checking and savings and all that. And they'll call and say, hey, you guys misplaced my Social Security deposit. You misplaced it, or you took it, or something. And do you really think that we misplace? It's an automated payment into an account, no one's touching it, it's automatic. It's not misplaced. Then they panic, and the people on the customer service line try and figure out where it is, and it doesn't show up. Maybe you want to talk to our financial advisor, so it gets routed to me. And then I'll start asking a few questions, and I'll say, are you working? Yeah, I've been working full time. What's your hourly rate? $9, $12, whatever it is. And I'll kind of grab a calculator, and I'll see that we've probably exceeded $17,640. I know what happened. You earned too much. What? Social Security sees your wages, they stop paying. It'll start back up in January. What? I can't make my house payment. You'll start to hear the frantic, what am I going to do? Well, the idea was to know this in advance and not allow it to happen. So talk to your manager, talk to your employer, and say, hey, I've got to limit myself to this, because if I go over, I'm stopping the checks. And you wouldn't want them to stop for 3. I mean, most people aren't going to work well in a scenario where income disappears for several months a year. They usually want consistency, right? So just be aware, if your plan is to retire early, and you're the guy that builds the spreadsheet, factor in the max income you can have is that $17,640. Goes up about $500 a year. It was $17,040, so $600 last year. After you hit 66, 67, your full benefit age, work all you want. Work full time. You could make $1 million working, and Social Security doesn't care. It's not an income-based or a needs-based benefit. It's a retirement benefit. You paid it. You paid it out of your wages. You're paying 6.2% of your wages to Social Security every pay period. Your employer's matching that with another 6.2%. That's 12.4% plus Medicare. I mean, that's 15+% going into benefits. So think about this. This is your retirement savings. But they do want to limit your ability to work early for some weird, quirky reason.
But they won't take any of those earnings you earn later to recalculate that 35
Okay,
years.
so great question. She's asking, will they take earnings that you continue to work and earn and pay Social Security on? And yes, they do. They actually recalculate your benefit every year you work, because think about it, you added 6.2% in plus the employer match. Now remember, they're going to take the top 35 years. So if this is a lower year than your 35th, then it doesn't impact it. But if it's higher than one of the lower ones, then it does impact it. It recalculates it every year. And also, if you end up working over, to be fair to Social Security, if you end up working over the limit while drawing early, you don't lose the money. They're not actually taking it. Anybody familiar with the concept of amortization? It's kind of like that. They take the dollar you didn't get, they spread it out over your remaining life expectancy. So you might get a penny or something a year. I mean, I'm exaggerating. You won't care. I promise you, when you turn full benefit, you get that extra $2, you'll be disappointed. But it's not lost, it's just kind of spread out. And so they defer it, is the proper term for what to do. Just be aware, work while drawing early can exceed the income limit. But what income do they count? Do they count my pension? Do they count withdrawals from my 401k, my rental income, my investment income? Do they count those? No, they don't. They count earned income. That's the legal term for it. That's working income. Think income you pay Social Security on. And you don't pay Social Security on investments. You don't pay Social Security. It's why Warren Buffett pays less taxes than you, because he doesn't work. He gets income passively. And you can too. If you own stocks, you can earn income passively. So you don't pay Social Security wages on those. All right, so we've talked about how they figure it up, 35 years. Can we draw it early? Yes, 62, reduced. Should we wait to draw it late? Well, there's a tough decision. It's about, life expectancy, family history, need. Tell you what, 10 years ago, when everybody lost their jobs in 2008, a lot of people went on early Social Security because it was there and you needed it. And maybe it wasn't a great plan, but you know what? It kept the house paid. So there's a lot of reasons. But you want to weigh those. Right now, everyone's feeling pretty secure. So you probably want to put it off if you don't have enough to retire on. But if you don't know, come see me or go see somebody, But the point is to know. I regularly meet with people that are nearing retirement, and they don't have a clue whether they're able to retire. And I can tell you that about 2/3 of the time, I end up saying, you could have retired 2 years ago. Or you could have retired 5 years ago. Or why are you working? It happens. And people don't know it. And then you show them how much surplus they have, and they won't spend that either because they really don't believe it until they've had it for a few years. And this is how that usually unfolds. The checking account gets bigger. And when it gets to an absurd number, then they go, I don't know where this is coming from. Well, I told you had a surplus every month. It all comes out in the wash. Or a deficit, and I'll let you know that too. Here's your deficit. Either work part-time to fill it, 3-4 hours, 10 hours, whatever, or put off retiring for this many months. Very easy. What you will know is when you can absolutely stay retired, because you don't want to notify HR until you know you're not coming back. Don't burn the bridge, but we want to make sure we don't need the bridge. That's my goal in life. All right, so we've talked about drawing early and late and then weighing the decision. Let's switch gears. I know this is going to be boring, and it's about 20 minutes till 1 and you've had lunch. So we're going to talk about taxes because I really like to excite you. Yeah. Do we pay taxes on Social Security? I mean, isn't it kind of a tax to begin with? Doesn't it come out of our paychecks?
Yeah.
Kind of like a tax. So the answer is maybe. 1987, prior to 1987, we didn't pay taxes on Social Security. It was a retiree benefit, fully taxed income that you didn't pay taxes on. But I used to do this event with the representative from Social Security. Her name was Ozella Bundy. She was the public relations liaison for Social Security. She retired, I don't know, 5, 6 years ago. And like many things, they're cutting back, so they haven't replaced her. Just like they don't print materials, just like they don't stay open past 12 on Wednesdays at the offices now, and they close early on Fridays too. So just beware if you go there, don't go there on Wednesdays and Fridays in the afternoon. But she would say, if you think Social Security is in trouble now, you should have seen it in 1987. Now, I was a high school graduate in 1987. Does anybody remember what was happening in 1987?
Stock market crash.
Lots of things happened in 1987. I bought my first stock 2 weeks before that event right there. I learned how to lose money quickly in stocks. Social Security was going bankrupt that year. There were a lot of news headlines about how it had less money coming in than going out, and there was no money in reserve, so that they wouldn't be able to make payments and they were counting the days. You can kind of picture the clocks and all that. That's how we do it with the debt ceiling and everything else. But then Congress got together and they passed a law, and it basically pushed out the funding of Social Security for about, 35, 40 years almost. What did they do? They began taxing Social Security if, and we'll go over the ifs, they began raising the age limits, like we've been talking about. It used to be 65, now it's 67. They began, what else did they do? Those are the 2 things that I can remember they did. And this is my point. It's a moving piece. It's not a set in stone benefit. I've already shared with you, they're probably going to raise that age again. They're probably going to do something else. I don't know if you guys remember this back in 2008 after the financial crisis. No, it was even before that. It was the first year Obama was in office, he put in place a group called the Simpson-Bowles. You guys remember those names, Simpson-Bowles? The left and the right came together with a think tank to kind of come up with solutions for Social Security and entitlements. And together they came up with the raise the age, change CPI was the second proposal. If your income's above a certain level, you don't get the raise each year. Now that hasn't been passed, but I would imagine that gets passed at some point. 2012, we passed the highest tax increase, and it included a 3.8% additional Medicare tax on incomes unlimitedly. Make $1 million, pay an extra 3.8% on all of it. These are the things that push out that funding. That's why I'm saying don't ever think it's doomed, even when the headline says it is, even when the news tells you, run for the streets. Ozella would say, you guys have no clue. I was around, I was a young employee, and we really were afraid of being stampeded in our offices because people were upset. And then it suddenly disappeared as an issue. Well, it didn't disappear, they fixed it. And I'm just going to say that they'll probably fix it again. So right now, if you see the reports from the Office of Management Budget, it's expected to pay till 2032. 2032, 2033 is their estimated time frame. Medicaid isn't expected to go that long. That's a scary thing. Many, many people count on Medicaid, not for medical care, but for long-term care. None of you guys really realize that probably, but for the last 30, 40 years, lawyers, maybe CFPs, maybe, have been suggesting, no, don't worry about long-term care. It'll pay for by the government. If you run out of money, they'll pay you the benefits. Well, that's now run its course for 30 or 40 years. Government can't afford to pay that. So Medicaid is expected to run out of money by 2026. It's only like 7 years from now. Because it pays long-term care benefits for people with less than $2,000 of assets. And that's a very expensive benefit. It costs about $70,000 a year per participant. So it's tremendously expensive. Unbelievably expensive. It's the $60 trillion cost we keep talking about. It's people are retiring $10,000 a day, I think it is right now. So, boomers. And some of those have already retired and already going into nursing homes. I mean, those costs are just ramping up. So how they fix that, I don't know. But I do think Social Security will get fixed, pushed out, so that maybe they raise the age for some of you younger ones. I think if you're 50 or 55 at least, that they're probably not going to touch you. But in the past, if you were under 55, they did raise your age limits. So just be aware that that's a moving piece to fix it. Why did I bring all that up? Because let's talk about taxes. Boy, that was a real divergence. Do we pay taxes? Depends on how much you make. You're going to want to write these two numbers down. They aren't anywhere in those materials. And it's going to depend on whether you're single or married. So if you're single, kind of stack these numbers one on top of the other. And above this, make the heading Magi. Magi. M-A-G-I. Not gift to the Magi, but modified adjusted gross income. And underneath it, write, if you're single, write 25,000. And the next number below that, 34,000. And if you're married, write 32,000. Underneath that, 44,000. And then over to the right of each of those numbers, I want you to write 50%, and below the next one, or next to the next number, 85%. And then we're going to write a little formula off to the somewhere, below, to the side, doesn't matter. Magi is not adjusted gross income like you're used to, bottom right corner of your tax return. No, it's not that. It's taking your adjusted gross income. Actually, what it's doing is taking half of your Social Security, just for the purposes of figuring out whether you count Social Security in your taxes. You count half of Social Security, so write half SS, plus other taxable income. Anybody here invest in municipal bonds? Any muni bond investors? Okay. There's an exception for what are typically tax-free municipal bond interest. If they're not, if they're private activity, then they do get added back in to this calculation for taxes. So it's one case where they're not necessarily not taxable. Anyway, half Social Security, other income, which is work. I'll give you some ideas to put next to it. Work, pension, 401k, IRA, all those taxable income sources. Not Roth, but traditional IRAs, 401ks, traditional, all these things that get taxed when you withdraw. All those things are counted into that Magi number. And when that Magi number hits the first number I gave you, that's when you start to add half of your Social Security into your taxable income. You're starting to pay taxes on it. Think about that. What if your Magi were $24,999 and you're working part-time and it's December 20th and you worked one extra hour and you hit 25,000. You just subjected half of your Social Security to tax. That was a $2,000 decision. That extra hour of work. Right. So in planning, I regularly let people know, hey, this is your work limit. If you go over it, you might as well work a lot more because it cost you about 3-4 months of income if you're part-time, and you just blew it. You gotta decide, is it worth it? And you want that to happen early on in the year, not at the very end of the year, because you don't have time to recover it, and earn more money to make up for the difference. There's always opportunities, by the way, to maximize income. So part of my planning, I'm being really loose with it here because it gets complicated very quickly, but I'm constantly telling people, hey, if you could just reduce your withdrawal from your 401k or IRA by $30, $50, $40, whatever, you'll save $2,000. Just do it. But I'll get less money. Yeah, but you're spending that money in taxes anyway. This will be free money. You'll make an extra. You'll spend less of your money and you'll have more spending money. That's a win-win. So we're constantly figuring things like that. It has to do with things like this calculation, Magi, taxability of other benefits. The way benefits and sources mix. I can draw from Roths that aren't taxable. I can draw from maybe recognized losses on other stocks. Or there's a lot of decisions that go into this, but it's about knowing where to maximize income and how to be tax savvy. That's not tax advice, by the way. I'm just calculating it and say, here's what it is if you do this. Here's what it is if you do this. Obviously, you're going to choose the right one. I didn't tell you what to do, but it's useful information. Yeah.
So, taking Social Security out of the equation,
Yeah.
if I would draw $25,000 out of my 403B, I'd be at that
Absolutely.
threshold, right? Okay.
Absolutely. Unless it's a Roth, which most people don't have. So to be fair, most people, it's not going to impact you. Most of us are traditional and should be. Most of us should be traditional because we're not probably saving enough to put us in a much higher tax bracket in retirement. Most of us are not doing that, right?
What's that number?
Well, depends on what your number is right now. So if you're in, let's say, the 10% tax bracket, but when you retire, you're going to be drawing out so much from all your money and your pensions that you're going to be in the 22% tax bracket, then it would have been smart to be saving in a Roth over a traditional. But in fact, 2/3 of us are just the opposite. We tend to have a less income when we retire. Some of us have more income when we retire. And in those cases, Roth was a smarter decision. I regularly hear advisors say, Roth, Roth, Roth. Roth is great. The article in the newspaper always says Roth. I've never found one that says traditional, ever. Kiplinger's Motley Fool, Roth, Roth, Roth. So if you were the unknowing investor, you just say, well, I'm stupid. I didn't do Roth. Well, I'm here to tell you, 2/3 of us shouldn't be doing Roth. Now, there is a reason to have Roth. For emergency reserves. It's like a shock absorber. It doesn't affect your taxes when you need money in an emergency. When you want to leave some money to a kid, that's a great use for a Roth. I use a Roth as a college savings vehicle. Phenomenal. #1 choice. But the majority of us are not going to benefit beyond those using a Roth, so don't want to divert too much. So we pay taxes, and we hit these levels. And once we hit them, they're unforgiving. It's not like you phase into taxability. Bam, $2,000 extra taxes. Bam, another $1,500 extra. Whatever your income levels are, it's going to adjust. But you want to be aware of these. You want to stay within them, not get too close to them. In your planning, you want to be savvy around them. Control your income that you have control of to maximize these. So yeah, we do pay taxes, but not all of us. I very often can show a retiree how not to pay taxes on their Social Security. I will tell you that almost always implies that they didn't retire with debt. Another cost of debt that we forget is we now need income to pay the debt, which then causes the taxability of our Social Security, which means we're less efficient than everybody else. I mean, these are the costs of debt. If we can get to where we have no debt, we'll probably live very comfortably on $2,500 a month. It starts to be very easy. I could live on $2,500 a month. I'm betting everyone in here can if you didn't have debt. So taxes, we did cover it. We're going to switch gears because we're down to our last 7 minutes. And by the way, if you have questions, you just holler. But let's switch gears and talk about some other benefits. I want to talk about married or divorced benefits, what are called spousal benefits. And I want to talk about survivor benefits. Because Social Security is much more than a retirement plan. I gave you the retirement book, but they have a book for survivors, a book for family benefits, a book for health care now. You know what Social Security's full name is? I don't even think it's in here. You've probably seen this acronym, OASDI, maybe. In the federal books, in the tax laws, it says OASDI. It's OASDHI now, and that stands for old age. That's what they originally called this. Old age, survivorship, disability, and now health insurance. Health insurance, Affordable Care Act. So it is more than retirement, old age. It is also survivorship, disability, and spousal benefits. So spousal benefits, let's talk about this. If you were married, or you are married, if you were married 10 years and divorced, or you are married, you have a spousal record. You don't get to see it, by the way. They don't send you a printout with your spousal record on it. If you didn't know, you would just ignore it. What is the spousal record? Well, if you're married or were married 10 years and didn't remarry, then that spousal record hangs out there for you to access when you retire. And you have a choice in that scenario. You can take your record, or you could choose to take your spousal record, and there's some reasons why you would do that. at certain points. And you might choose to take the highest of the two. I'm going to show you a reason why you might choose to take the lower of the two first and then switch over. We're going to talk about that in a sec. But that record is there, and it really does, it has nothing to do with your spouse, beyond the fact that it's just there for you to access that is on your spouse's work history. Will your spouse know you're taking it? No. Can they stop you? Will it affect their benefits? No, no, no. It doesn't affect them at all. It's just the way this insurance pool of benefits was built. And the way it works is this. While your spouse is alive, you can take half of what their benefit is or your benefit. You have that choice. I had a couple 6, 7 years ago, been with me a long time, but he was a musician and she was a worker in municipal government. And she had a full work record, but he had a musician's work record. You know, they don't report. He did gigs. They probably paid cash. I don't even ask if he reports it. I'm not sure I want to know. But my point is, he said, well, I obviously don't have a Social Security record, so, you know, we can't count on anything for me. And, you know, I gather all my facts in my first meeting, which sometimes people say, why do you need to know all this? Well, then I tell them why. And this one, they ask that. Well, because you might have some benefits. No, I don't. I didn't work. No, yeah, you do, because she worked. You have spousal benefit you don't know about. And in my planning, I built in that, you know, her Social Security was going to come, and when he turned 62, he's 10 years younger than her, by the way. Wow. And he's going to be, boy, I mean, she went for a musician that was younger. Anyway, he's going to have a Social Security record based on her benefit that's half of her benefit. It meant that they could retire. You know, she was continuing to work and planned to work. And again, in my second meeting, I said, you guys could have retired like 5, 6 years ago. But our planner that we pay $250 every time we meet, $500 every time, never told us that. Well, no, I'm sorry, but I didn't charge you. And it's going to be true whether or not you believe me. Here's why. And I explained it and showed them and all that. And sure enough, so she decided immediately to retire. Gave notice, started the pension, drew her Social Security, later on turned on his Social Security. Built on her record, doesn't impact her benefit, doesn't reduce it at all. So know that if you were married 10 years and didn't remarry, you still have that benefit. It hangs out there forever and ever and ever. And you get to choose which one you want. It's not an automatic decision. You go into Social Security to find out what the benefit is. You will need their Social. So that's the only catch. You got to know their Social Security. They may be able to find it based on your Social Security in some reporting, but I would know his or her Social when I go in there so that they can verify marriage and then they can verify the account. And they'll tell you what that benefit is. Why would we want to know this? Well, there's a very common spousal maximization strategy we're going to talk about for a brief minute. And that has to do with how to get the most out of Social Security. Sometimes see this promoted on the radio and on billboards and everywhere else, in print. And a lot of these max strategies kind of disappeared about, well, when that 2012 tax law changed, a lot of these got cut out. But this one still exists. So a spousal record max goes like this. Let's say both spouses wait till full benefit age. Let's just, for the sake of argument, say that they have about the same income. Let's say they each make about $40,000 a year, and that they have 35 years, and that they're the same age. Okay? At 66, when they hit full benefit age for them, one could choose to draw their Social Security. Let's just say it's $2,000. The other one could also choose to draw their Social Security as $2,000, but using a spousal max strategy, instead they choose to draw their spousal benefit of $1,000, half of what they would have gotten from age 66 to age 70. So for 4 years, they're going to get $1,000 less than they could have gotten. That costs them $48,000. So there's not that's a lot of money. But at age 70, because they didn't touch the one record, that benefit kept growing. At age 70, it's about 34% higher. And then they can switch over to their own record, which was $2,000, but now it's $3,000 or $2,700. And they get that for the rest of their life. It doesn't take much time for that to end up getting a lot more money out of the system. Been calculated to give you about an extra $50,000 to $60,000 out of the system, which is a pretty major benefit to a spouse. There's one for single people too, but that's one that's still there. I'm going to put the caveat here, and I'm going to say it really firmly, because a year from now someone will call and say, I didn't explain it right. So what you heard me say was, they both waited till full benefit age. I've had CFP, I'm a CFP, Certified Financial Planner. I've had CFPs call me and say, you told that they could take it at 62 and then switch over at 70. No, I didn't. I've had CFPs actually do that in their own plans and didn't know it. It has to be full benefit age. Both have to wait. One can't wait and the other one not wait. Full benefit, you heard me say it 3 times now. Full benefit age, full benefit age, full benefit age. Now you've got a max strategy possibility. And it involves some risk too. If you died young, this wasn't such a great decision, but again, you kind of take it into account, figure it out. And as always, if you can't live on it, why do it? But if you can, that's just a lot of extra money forever after that. And it's only 4 years. I mean, if you can figure out a way to make it happen, it's a great idea. For single people, here's a strategy that I would almost always recommend you do. Again, full benefit age. You heard. If you hit 66 or 67, you could choose to draw Social Security right then and continue to work. You could do that. But I wouldn't. I would suggest you go to Social Security and file and suspend your benefit. What does that mean? It means you just go down there and you do a formal filing that you want benefits, but then you suspend the payments so you don't actually ever get one. And what that does is it creates a record that you filed and suspended. And it gives you an option you didn't have had you not done that. That option looks like this. Let's just say that you're working and your plan was to work to pay off the house. But what if the employer lets you go? And that plan didn't work out so great. You could then elect to go to Social Security and say, I'm 67, my benefit's a little higher, but instead of actually taking it, I want the first benefit and all the back payments. Think about that. It's like 18 months, 24 months later. I want the back payments for the lower amount, and they'll do it. You have now just created an option to pay off the house should your employer have let you down. That would be a great option. I've actually had that work in plans. And it may not sound important to you now, but I want you to relive 2008. Nobody saw it coming. Some people retired. Some of them wished they could have paid off their houses. This created a way to pay off the house when they lost their job, when it was most necessary. So a very valuable benefit. I would consider doing it if I'm single. And the spousal max if I'm married. And you can afford it. We're out of time. I'm going to hang around for a little bit just for questions. But we've covered a lot, really a lot. We got into some advanced strategies too. This is the tip of the iceberg. You guys have gotten a deep understanding, more than most, but there's still a lot more to it. And it all fits into a much bigger topic of financial planning. By the way, I didn't introduce myself. I'm Mark Lopresti with Summit Credit Union and Lincoln Financial Security. We do a lot for our members. We do informational sessions. All of our financial planning services are free to all of our SEG group partners and members. That means you can sit down with a CFP like me, figure out your planning. It costs you nothing. It costs you nothing. Of course, we offer a full suite of investments, bank accounts, checking, savings, loans, online, everything. So we're a full-service credit union. And I help our members plan, prepare for retirement, beach houses, college, whatever. Whatever the goal is. I've been doing this for a long time. Started buying stock when I was 18 years old. And again, I said I lost a lot of money the very first 2 weeks. So I learned that they're not guaranteed. And that's only one kind of investment we deal with, but it is one kind we deal with. We all know that there's risk in our 401k plans. I help people determine if they're really capable of that risk. Sometimes we're taking it and not aware of it. And some of us are fully aware of it and comfortable with this, Know that there are investment options that don't involve risk, too. But if you're just curious about what you're doing, is it in line with your goal of retirement? Will it be disturbed if we suddenly had a market reset right now? Be happy to sit down and talk with you about it, just to put your mind at ease. Our market's dangerous right now. I'll give you my little 2 cents. Historically speaking, they're more expensive than they are 98 out of 100 years. So is it a warning? Not at all, because it's been this way for over 3 years now. It could continue to go this way for 5 or 10 more. But just be aware that I remember this kind of feeling in 2007 and 8. And then I also remember 1987 when in one day the market fell 20% in about an hour and a half. And I could see an event like that happening again right now. I could. It was right after Reagan was in office for 3 years. And I was just a kid studying economics at the University of California, San Diego. Didn't know what I was doing, but I got a crash course in how markets reset value quickly. The good news was if you stayed with it, it worked out. It took about a year or two to recover, but it did work out. But boy, if you were retired, you'd probably have a heart attack if that day happened, your day of retirement.